Okay, we're on. Good morning. Good morning. Great to see everyone. Hope everyone's having a great Thursday. It's been super hot outside, so we have a very exciting topic today, newsworthy topic, relevant topic, and very excited to present this to you. So today we're going to talk about the one big beautiful bill and what this means for you as a senior. We have a lot of great topics, a lot of actionable tips here. So before we get started, just some quick housekeeping, an introduction. We've seen a lot of people before on the webinar, but for those who are new, my name is Robert O'Keefe. I'm a real estate broker in Monmouth County, New Jersey born and raised. And what we do is we help seniors make educated decisions when planning their relocation plans. You can always send us a direct message. We have a lot of times we're in communication often, and you can always go. Probably the best thing to do is just go to our site first, over55nj.homes, and you can search all the inventory. You can customize an area. There's so many great things you can do with the site. You can cap your HOA fees. You can search what specific type of 55 plus community you want, whether that be an apartment style, a single family, pet friendly, pretty much you name it. It's on the site. And it's a really great niche. We really love it. We really love working with seniors. We really love the advanced planning aspect. We realize a lot of people are 2 years in advance on average from when they're moving. So it allows us to really get to know you and help build a really solid relationship with you while providing value like this in between. So that's the first thing. The second thing is just quick disclaimer: we're an apolitical organization. We're not here to sell you. We don't have any lobbyist money, and we don't have any special interest. So the way we see it is, what we like to do is we like to present the facts to you, just the straight facts. There's good things and bad things with any bill, and this way you can make the best educated decision for yourself. We don't have the budget to compete with the CNNs, the Foxes, the MSNBCs. Those organizations would pretty much crush us like an ant. So we're not here to sell you anything. We're just here to present the facts, and we kind of like it that way because it's a nice little niche for ourselves where you can take the facts and just kind of digest the data, and we can give you a lot of actual tips as well. So if you want copies of this presentation, if you want some notes, just send us a direct message. You can always write copy in the notes, and we'll put together a nice little cheat sheet for you because we're going to cover a lot here, and there's going to be a lot of great actionable advice. Then the last disclaimer is this isn't financial, tax advice, or any advice of any kind. Like I said, with the cheat sheet, with any advice we give you or any things we talk about today, please discuss this with your CPA, your financial advisor, tax advisor, things of that nature. And this is kind of like a good precursor to those discussions where you can bring this to their attention and figure out what's best for you. So let's go into the first benefit. So this bill is big, hence the name, one big beautiful bill. So this is actually going to be a two-part presentation. We'll have the next part next week for you. But we're going to talk about three main topics today. The first one, which I think is pretty cool. So the first one is going to be the Trump accounts for newborns, also known as MAGA Baby Accounts. So why does this matter? So quick story. When I was a young boy, I was probably like 8, 10 years old. My grandparents took me to the bank to open up a custodial account. So at the time, it was Ridgewood Savings Bank. The account was called Mula Mula, and it was an account especially made for kids. But I had that fantastic memory with my grandparents, just taking me to the bank, opening the bank account, showing me how a bank worked. So obviously the accounts like for the next generation, maybe your grandkids, maybe someone you know, maybe someone you care about. But it's a really great opportunity for you to be that financial resource like my grandparents were to me. So you can see what a profound impact it had on me. Here I am decades later telling you this story. And it really kind of got me started on learning about money, and just a beautiful memory overall. So you could be that person if you wanted to set this up and you want to kind of bring this, even if you have like a son or a daughter, or if, like I said, if you had someone you care about, you can kind of bring this to their attention and say, hey, look, this is pretty cool. You might want to take advantage of this, or you might want to look at this, and then just basically go and take the initiative to set this account up. So let's get into the specifics with it. So this accounts for newborns born after 2025, and it goes from the limit for the newborn birth account to qualify as 2025, January 1st, 2025 to December 31st, 2028. It applies to any baby with a valid social security number. Accounts are automatic. And what's cool is the government will automatically deposit $1,000 into the account. So, pretty much, I wish I had that. I'm sure a lot of us wish we had that when we were born. It's a nice little head start that the bill will give you. So, automatically, regardless of age, regardless of where you're from, regardless of income level, these new babies, these MAGA babies, start with $1,000. Now, what's really cool and what I like about it is there's you can deposit up to $5,000 a year into this account. So it works kind of like the comp to it, if you will, to borrow a real estate term. Is it's kind of like a 401k with the max deposit being $5,000. So what's cool is let's say like if you had 5,000 it's $5,000 per person. So if you had someone that you want to deposit to, if you wanted to deposit another $5,000 into another account, different people can deposit money into this account, and it grows like a 401k. The funds must be kept in a U.S. stock index funds. We're going to probably have more on that in the future when these accounts open. I'm sure Vanguard, I'm sure Schwab, a lot of the big guys will pick them up. And we'll kind of have a resource for you as we go along because this is just so new right now. But it can't be any risky or high fee investments. And it kind of just works as an index fund. If you're familiar with index fund investing, these are just low funds that grow over time that track an index like a group of stocks on the stock market. And they're meant to be long term growth focused, meaning you shouldn't take them out. We'll have more on that in a bit. But you can just put money in and just watch the stock grow essentially. So when the child becomes of age, they have a nice little start, if you will. Um, Now there's limits, which I think are pretty interesting. So let's say you can. So for the record, you can technically take out money ahead of time. It is taxed as a capital gain, so you wouldn't want to unless you needed to. But up at age 18, you can deduct up to 50% of the account for education, housing, or starting a business. So you have to have a valid reason. From ages 25 to 30, you can access the rest of the account for the same purpose. And then once the person reaches age 30, it just becomes an ordinary account where you can withdraw it tax free. So you have full access at age 30. And the smart thing to do would be to just keep contributing to it and let it compound and use your other savings elsewhere. But it's just a really neat thing. And it's just a really something that I think is really positive. Now, let's talk about the growth potential and what this will look like. So if you just left the $1,000 deposit in and it grows at 7% annually, it could reach approximately 3,400 by age 18 and 7,600 by age 30. That's the power of compounding, just doing nothing. But with regular contributions, growth could exceed up to $500,000 by retirement age. And that depends on just how many people are putting into the account. And so you could really put in as much as you want, up to $5,000. If you want to put in like 100, 200, whatever you feel is appropriate, you can really give the child a head start, and they'll be very grateful for it. And like I said, like going back to the story, is you could be that person that sets this up for your family, that educates the family about it, and just take the initiative, because a lot of times things get really busy, especially in the life of a parent. I can tell you that firsthand. I have two little ones, but if you have the grandchildren, there's kind of like a special relationship between a grandchild and their grandparent, where grandparents can just like kind of take the lead and set their grandkids up with this. So it's kind of a special thing, kind of an interesting thing they put in there. Now, let's talk about the benefits, automatic start. So there's a lot of benefits to this. The education and wealth building, giving someone a head start. We're going to go into like the gifting tax limits in the future. Like that's another thing that the bill did, was the gift tax exemptions are increased as well. But there's a lot of benefits to that, where someone can just get a head start, and someone that you care about can just really get accelerated, whether that be their education fund, whether that be starting a business, maybe a trade school. There's a need for like plumbers, HVAC people out there like crazy, where if someone wanted to start that business, you can give them the funds and have this started just to pay for your whole trade school. So a lot of benefits there. Now, the cons obviously are the restrictions. So you are taxed if you take money out of it sooner. There's no tax deductions similar to like an IRA. So these, when you give it, you're not going to get a tax break from that. That's not really the intention of it. The intention is long-term growth and not tax deferrals or tax limitations. And then there could be some of the politicized branding with it. It is called a Trump account, unless named otherwise. It's also known as MAGA account. But I want. Sorry about that. Just lost power for a second. So there's where was I? There is the politicized branding, but I would just get over that. I would just rename it whatever you feel like in your mind because it is a great account to take advantage of. Now we'll go into some other vehicles later down the line. Oh, okay, Kim. Yeah, I'm talking to my assistant Kim in the chat here. So Kim says we did not lose power. So all right, so we're back and running. So we'll talk into some other benefits of some different vehicles you can give to your grandchildren later down the line. But this is a kind of a solid one where every child starts off with $1,000 and you can contribute $5,000 annually. We'll talk about also the gift tax exemption that's going to go into effect as well. That's going to be in part 2 next week. So, how this connects to you. So, like I said, legacy planning, if you have a high value estate, it's a great way to reduce your estate, to gift people, to give family and loved ones money. Multi generational wealth, kind of building for the next legacy. Um, there's just like a lot of great things you can do with it. So, we'll talk about that in the next section. But that is essentially the nutshell of the Trump accounts, also known as the MAGA Baby accounts. So I'm curious if you have any questions or if you have some thoughts on it. Just drop the comments below. This is a safe space, so feel free to drop your comments or any questions on the Trump accounts there. Now this is exciting. So this applies to everybody, not just the future generations. So topic number 2 is there's a new $3,000 income deduction for Americans ages 65 and older. So obviously, tax rules are complex. Every situation is different. So you definitely want to talk to a CPA on this. But a lot of times, like when they were floating this bill out there, they were floating no tax on Social Security. That didn't make it into the bill. So kind of as a like a loss leader, if you will, or as like a buffer, they put in this $3,000 deduction for seniors. So unfortunately, the tax on Social Security is still going through, but now there's an additional $3,000 deduction on taxable income. So let's just say, for example, just to do the math, let's say if you have $3,000 taxable income, your taxes would now read $27,000 thanks to this deduction. Now, we do have that cheat sheet you can provide your accountant. A lot of times with accountants, I found you really, and I talked to a lot of people, I talked to a lot of real estate investors about this, that you really have to prime them and kind of like educate them sometimes just to make sure you're getting all the deductions you're entitled to. And the best way to do that is to send your accountant a quick memo, whether it be email. Sometimes you can go and meet your accountant in person and just go off a checklist on everything you could be getting. So a lot of times there's just so many things, especially in the accounting world, things go through the wayside. So you really want to make sure that you're prepared when you go meet with your CPA every year. I have a question here. All right, great question, Lori. How is this different from what's already in place for creating for accounts for grandchildren? So we'll go into the Q&A too at the end. I just want to answer this right now while we're on the Trump accounts. So it's a bit different because it's a government-run program where the government's starting at $1,000 automatically, and it's just another vehicle. So let's go into the main vehicles very briefly before we go back to the deductions. So a lot of times there's a trust where you can start a trust for your grandchildren or family members. You basically set the rules of this trust. A lot of times you can set the own rules, like when the person can access it, what the trust funds are for. This is a government created program where everyone starts with $1,000, and then you can contribute $5,000 from there. So there is trusts. Another common vehicle is a 529 plan, which is basically used for higher education purposes. So we'll go into that more into the second part of the video. Also, if you want to dig into more of those questions, we can go into them further in the Q&A. But the main vehicles are that we see are 529 plans. Those are just used strictly for college, for private school expenses. And then there's the trust accounts that have a little more flexibility where you set the rules. And then there's this the new account from the One Big Beautiful Bill called the Trump accounts, the MAGA Baby accounts, where those rules are what I just specified, $5,000, and everybody starts with $1,000. What makes it different from the other ones too is you start off with $1,000 automatically from the government. So some key differences there. But great question. I really appreciate that. We can go more into it in the Q&A too. Um, so the $3,000 deduction. So that's pretty much self-explanatory. It's a nice little extra tax break. Works with other deductions. Helps with everyday costs. Some concerns. It might not help low income seniors that much. $3,000 is small in a lot of states. Social Security is still taxed, but just a nice thing to be aware of and a nice thing to take advantage of because when someone gives you kind of a layup like this, an opportunity, it just makes sense to take it. So nice little benefit in there, especially for our senior audience, is that $3,000 deduction there that you definitely want to take care of. Now, the next thing and our final topic this time around is going to be the Medicaid and healthcare changes. So this is a bit of an indirection. So we're not really sure how this will directly affect you. The other ones are a lot more tangible and a lot more kind of like salient, if you will. This one is a bit out of someone's control. So with the Medicaid, there's a big $1 trillion cut to the Medicaid program. So this includes like a few things. So the main thing I would look at is the home equity limit is now set at $1 million. So that starts in 2028. That's really the big one when it comes to advanced planning purposes. If you have a value of your home, let's say a lot of times when we speak to people, a lot of homes are debt free and people own them 100%. If your home is over $1 million, which a number of homes are these days, you could be disqualified potentially for Medicaid based on that home equity cap. Now, this starts in 2028. So it's something to look forward to. It's something to look out for and something to plan ahead for. The easiest way to plan ahead for this is simply to downsize, go into a 55 plus community, go into a smaller house. We help seniors with both options. But the way to safeguard yourself from this and making sure that you're still picked up on Medicaid is to downsize and is to get into a lower equity solution. So kind of a good problem to have. If you have a ton of equity in your house, if you have more than $1 million, it's a great spot to be in. We'll go more into the tax deductions in the next presentation when it comes to the sale of a property like this. But this is a good incentive to downsize if there is any, and just kind of something to plan ahead for. Now, I don't want anybody to rush right away. It's going to be in 2028. You still have more than enough time just to get things in order here, but it's just something to be aware of. The next thing when it comes to this is the Medicaid redetermination is going to be every 6 months now instead of annually. So basically what the government is doing is just making sure everybody qualifies for Medicaid because it is so expensive. There is a ton of baby boomers aging into Medicaid qualifying years. So the government is going to look at this every 6 months. So again, the best thing to do is just to go off on kind of like our cheat sheet, kind of off the memo that we can send you, and just make sure you're staying on top of this and to set a calendar reminder just to stay on top of it. It goes back to what we all lived through with COVID. I remember a lot of like the programs and a lot of the rental programs that I dealt a lot with got taken up immediately by people applying for it. So the best way to stay on top of this is speed. I don't think Medicaid will run out. I could be wrong. I'm not really sure how that would work in that case. I don't want to scare anybody, but the best way just to stay on top of everything is speed. When someone sends you out the redetermination notice, just get that in as soon as possible and just stay on top of it and just hit that ball back in the court of the government. We tell buyers this all the time when they're applying for a mortgage. Don't let it sit. If the lender or the attorney asks you for something, just like pretend like it's ping pong. Just hit that ball back in their court and just make sure you're getting everything in as soon as possible. And the best way to do that is with technology in this case. If they don't send you a notice, just make sure to be reaching out to them for your notice, just to make sure that you're on top of it and you don't lose any coverage from administrative error. Again, it just comes with just staying on top of everything and just making sure that you're eligible. Um, so obviously, the takeaways, there's a little more difficult to qualify if you have stronger assets over $1 million. You might want to start planning ahead for that. And then just to be as fast as possible with your paperwork. Risk of losing services, I don't want to scare anybody, but I think if you plan ahead here, if you just get all your documents in on time, I think you should be fine. Sometimes cuts are good, and sometimes the cuts are made for a reason. So as long as you're smart, as long as you're leaning on us, your tax advisors, everybody should be okay there. And it all just comes from planning ahead. So watch your mail too. Medicaid renewals and recertifications will most likely start in 2026, where this will start to go into effect. Like I said, talk to an expert and just stay on top of it, and always lean on us with any questions. So we'll have another topic next. Like I said, it is a big, beautiful bill. We'll have another topic next week on this. We're going to start to open it up for Q&A, and feel free to drop your questions in the comments. This is exciting stuff. We're really lucky we get to present this and just go over this with everybody. So the first question is, how do you plan to adjust your tax filing in 2025 when this deduction becomes active? So I would start to get ready. I would reach out to us for a copy of the checklist and a copy of the memo. But I would just, it's so new right now where I would just stay the course, if you will. Start to look out for just different changes. 2025 is just going to come around soon before we know it. We're only in July. But I think more towards tax time, if you could just take out our checklist we can send you just to present to your CPA, I think you'll be well ahead of the game. So long story short, I probably wouldn't do anything now. I would start if you are looking to contribute to the Trump account, the MAGA Baby account. If you do want to liquidate your estate a little bit, that's a great opportunity just to decrease your tax burden there. But I would just stay the course for now and just look out for the mail. Are there any risks or burdens for seniors who want to contribute? For example, how does it affect their gift tax limits or Medicaid eligibility? Another fantastic question. So the gift tax limits, and we'll go into this next session, but the gift tax limits are actually going to increase up to $19,000. So let's say if you did want to contribute to a Trump account for someone, if you did want to max it out at $5,000, your gift tax limit would be $14,000 now. 19,000 minus 5,000 equals 14,000. So it is just kind of something you have to be cognizant of. Some people want to do other accounts too. Maybe, let's say, for example, you want to go into a 529 plan. Maybe you have a trust. The 5,000 would be limited to the Trump account if you wanted to max out that. So if we're there, and in 2026, you would have 14,000 left to play with. And you might want to split it up between a trust. The 529 plans are excellent as well, but they do count against your gift tax limits. Medicaid eligibility, I don't see anything that would affect that with your gifting. The main thing to look out for would be, it is good because it does decrease your taxable income. And the main thing to look out for is your home equity, which is something important there. But the gift tax and gifting shouldn't have really anything to do with that in terms of your home sale. All right, we are legal residents of NC with a mortgage on our home there, and we have a fully paid home here in New Jersey that we might be selling. That's exciting. I'm interested in anything that we could watch out for as tax ramifications. So it really goes into the primary residence exclusion. So this was not covered in the big, beautiful bill. This was actually put into law in the 90s. So the best way to explain this is a story. So I recently worked on a house in Wayne, New Jersey to sell. The owners did not live there. And because the owners do not live there, there's going to be a capital gains liability. The owners had their family there, and pretty much had it kind of like a setup as a life estate or like an investment purpose. So there is a capital gains there. So the capital gains exclusion applies to your primary residence only. So unfortunately, so because it's not your primary residence, it's likely going to be a capital gains hit. And there's ways of countering that. There's ways of deferring that. The most popular is a 1031 exchange, where you roll in the gains into another property. We can have a whole nother webinar on the 1031 exchanges. We do them a lot. But we have a saying that you should never sell, you should always exchange. But we have a lot of sellers too that elect to sell as well and just take the capital gains hit. Maybe they don't want to manage real estate anymore. Maybe they're at that age where they don't mind paying the capital gains, 15% of the gain. But if you don't want to pay tax, you can always defer that and roll into another property. This could be a vacation home too. If you want a vacation home and use it for Airbnb or vacation rental income, that's another strategy there for deferring gains. But long story short, if it's not your primary residence, you could expect to pay a capital gains tax there, because the government's going to recognize that not as your primary residence, but as an investment property or secondary property. If you had to advise a middle income senior right now, what 3 specific steps should they take before 2026 to prepare these changes? I would just start to look at all your finances. Number one, I would just put everything on a spreadsheet. We can give you a copy of what we call the net worth sheet, where you just basically put everything on a spreadsheet and it calculates all your assets and what they're worth. If you have a home, a property, we can give you a complimentary evaluation on what you could expect to make from the property, the estimated sales price, the mortgage, the transfer tax, and just estimate your equity that way. But start to get everything on paper, and then set a reminder to track it every month just to make sure everything is going up. Stay up to top on all your bills. And also start to look into the gifting and the capital gains, not the capital gains, just like the gifting, because the more you give, the less your estate tax should be in a lot of cases. A lot of states have estate taxes, not just federal. That's another topic I keep talking about the next show we're going to do. But the federal gift tax, the estate tax limit was raised too in this bill. So that's another exciting perk to it. But a lot of states have estate taxes that you want to watch out for. So another year ago, if the year goes by, we're in July already, and you don't max out your gift deductions, you're going to be taxed on that amount. So just make sure that you're gifting, that you're lowering the balance of your estate. Make sure that you know the value of your estate. Just kind of a ballpark idea. It doesn't have to be down to the penny in a lot of cases. But just start to get everything in writing and start to put a plan together. Happy to take a look at your plan too. Another good thing is make sure your will and estate is in order. Have so many people that sometimes they have family members that die without a will, die without a clear plan in place. Some people that don't know where the wills are when their parents pass away. So make sure that not just have all those things in writing, not just have the will, but also have directions to the will, directions to the safe accounts. Put together a plan and have everything in writing. The best way to do that is just to go over it with the person and then follow up and have something in writing, whether that be an email or like a secure note in a secure place, just dictating where everything is. We can go over that with you. We can go over that, and happy to take a look at your plan too. But just make sure that you have everything in order there. All right. Here's another question from La La Lynn. If I sell my home and go into a rental, do I have to pay capital gains tax? So if it's your primary residence, meaning if you live there, there's limits. So let's just do a simple example. So the limit for a single person is $250,000. So let's say if you bought your home for $500,000 and then you sold it for $750,000. If you sell it above $750,000, so the limit is $250,000 for a single person where you won't be taxed if it's your primary residence. The married couples, that doubles up to $500,000. That's called the capital gains exclusion. So you're covered and you don't have to pay capital gains if it's your primary residence and if you stayed there for 2 years. So that's a great question on that. You'll be surprised how many people don't know that. And we're talking about highly educated people because they never teach us this in school. I have clients that work at like Facebook, Amazon, and a lot of people just like aren't aware of this. And sometimes they'll make decisions like, hey, I want to keep my house as a rental property, but then they lose their capital gains exclusion. So that's an absolute dynamite question, and you'll be surprised how many people don't know that. But the rule of thumb is it's got to be your primary residence. You have to be there 2 years, and then there's limits. So for single, $250,000 is tax free. For married people, $500,000 is tax free. And for a rental, you would have to do a 1031 exchange to avoid the capital gains tax. Let's see. Here's another question. So if these accounts are invested only in stock index funds, what happens during a market crash? Is there any downside protection? So no matter what vehicle you're in, whether that be a trust, whether that be a 529 plan, whether that be a Trump account, you're kind of at the whims of the market. Now, you can Google the historical exchange of the S&P 500 index. I like Vanguard is a great account where you just get the total stock market index. The average returns are 7%. But like, let's say hypothetically, let's say if the market did crash, every stock is subject to fluctuations. But this is more what's great about indexing, it's called. This is more or less, this is a long term play. So if the market does crash, there's plenty of time to rebound. So if you have a MAGA account, let's say if the child's 1 or 2 years old at this point, there's about 18 years to make up the gains. So if it's a crash, that's even a good time just to put money in because you're buying low and everything's on sale. I bought a lot actually during the tariff news when the market was going down because I knew the market would go up again. So that's a good time. If there is a crash, if you haven't maxed out your deductions for the year, that's actually a good time to buy in a long-term play like this. And it's really easy to track. If you have an iPhone, you can track the stock market on your iPhone. One of my favorite sites is wallstreetjournal.com, where you can just see how the market's performing daily. But it's a long-term play. The average gains are about 7%, 7 to 8% on an index fund. It's a very safe investment, and the compounding is magic. That's the real value with these accounts. It's just the compounding over time. Just you set it and you forget it. And whoever has the Trump accounts are going to be so thankful. I wish I had one when I was a baby. How realistic is that lower income families will benefit from Trump accounts if they can't afford to make additional contributions? Yeah, so that's probably some of the criticism and the politicking with the bill. It is open to everybody, no matter if you make $1 or $1 million. So there's no income limits. There's no limits based on where you're from. But you do have to make sure that you're making money to take care of yourself before you put money into the account. So it just comes down to just like basic math, budgeting. A great resource. What I like is Dave Ramsey is a great YouTube channel. He talks about this, starting the emergency fund, making sure everything's paid, paying off your debt, and then to invest in accounts like this. It's called the debt snowball, he calls it. Pay off your debt first, set an emergency fund. It's a great resource. If you want to message us, we can send it to you. It's called the baby steps. But it's a great point. It's a great question. You just want to make sure everything's taken care of before you invest in anything, whether that be one of these accounts, whether it be the stock market, pretty much everything. Just make sure everything's taken care of first and everything's in order. These great questions. We really appreciate it. Just want to express gratitude. We thrive on the questions, and we just want to make sure that it leads to a better show. And I guarantee other people have these questions too. I always say that, but don't be shy about asking. With that, our last question: what's one small step you could take today to better prepare for the changes ahead? I would say just get a baseline. Get a baseline, track everything. Our spreadsheet is a great resource, but just get a baseline of where you are. And that's how you know where to go and where you're going. So with the baseline, there's probably some apps that can do it. I like to digest it in a spreadsheet, which is very useful. But excuse me, um, get a baseline of where you're at, track everything, track your net worth, track everything on a monthly basis. Some people do it on a weekly basis, and just get like an understanding of where you are so you can make a plan ahead of time. AI is a great resource where you can model some things out. The internet's a great resource, but it just comes from the daily discipline of tracking where you are in the baseline that you have. And I think that's a really great thing. The small step too is you can always reach out to us for advice. I'm happy to talk to your individual situation. We're always accessible. So um, it's really great. I'm so thankful. We're so thankful for everyone that came, that stuck around. If you missed it, we're happy to send you the recording too. Feel free to message anyone, invite anybody to our group that you feel would benefit from this. We're so thankful for your questions, and we really enjoy the questions and the feedback. Next week too, we'll have the part two of this presentation where we're just going to go into the other half of the bill. Like I said, it is a big bill, beautiful in a lot of cases, limitations in some others like any law, but it is a big bill. So we're going to cover it in a couple parts here for you. And we're always here as a resource for you. You can always send us a direct message. Our email address is over55nj@gmail.com. And if you want to kind of peruse the inventory, go to our website at over55nj.homes. You can set up searches not just for 55 plus communities. Some people don't want to be in a 55 plus community. They just want like a smaller downsizing solution. There's options there on the website. And if you have a specific community you want to be in, I had someone today that really liked Greenbrier 2 in Brick, New Jersey. Shout out to them. You can actually search that on our website. So please keep the questions coming. We really love putting this on for you. Really love interacting with you. You guys are our people, so we just want to say thank you so much. And it's just an honor to be a resource for you. We're here for you anytime. Thanks again so much for watching. We'll see you next week for part two. Thanks again, and stay cool out there.